Enlisting the Market and Climate Change and Fiscal Risk. We have some great panelists here to discuss this topic. The first person here on my left is Ali Zaidi. Ali is the White House Office of Management and Budget's Associate Director for Natural Resources, Energy, and Science. In this role, Ali leads a team of policy and budget experts overseeing policy, budget, and management issues across a portfolio that includes the U.S. Departments of Energy, Agriculture, and Interior. To his left is Lance Pierce, who is the president of CDP North America and has a responsibility for strategy and delivery across the range of CDP programs in the United States and Canada. Many of CDP global initiatives, including carbon pricing, are led out of Lance's office in CDP North America. And to Lance's left, the last person on our stage is Mike Williams. Mike is the managing director at S&P Global Ratings based in London, where he has a global responsibility for the firm's infrastructure, environmental, and climate risk research. But I'll hand it to Ali.
Well, thank you for joining us. I think this is an important discussion. Oftentimes in climate, we talk about pricing in the abstract. We talk about how we can start to curb emissions by thinking about them, by quantifying them, and the sort of the negative impact they have as externalities. Today, we're really looking at less than the emission side. Really, how does climate risk manifest itself already? And what will it look like going forward to the fiscal picture for the United States? And I think this is a salient conversation for this group because it's not just the United States that faces this challenge. It's businesses and it's other sovereigns as well. And my two fellow panelists and discussants will tackle those in course. I'll start by walking you through some of the new analysis that we've done, which we will actually put out tomorrow, so you are the beneficiaries of a sneak peek. So let me start, before I get to this fairly noisy chart. We've, for now a couple of years, been looking backwards at how climate has started to impact the U.S. budget. And we've found that extreme weather events, the direct costs associated with that, hit into the tens and hundreds of billions if you take the decadal view. Really, this analysis represents the first time the executive branch is doing a look forward in a concerted way on how fiscal risk will likely impact us going forward. Just to understand the general sort of analytical paradigm here, we've compared sort of ambitious, aggressive climate action scenarios with no action scenarios. For a lot of these analyses, we've looked at different global climate models, and what you see here are actually averages across different approaches. So we looked both at the fiscal picture obviously is informed both by revenues and by expenditures. For revenue side, we took the sort of gold standard economics, macroeconomic modeling, and then walked that down to fiscal impact. There we saw the potential impact, and this is sort of covered up perhaps by the chairs, but I'll walk you through it anyway. We looked at the sort of 4-degree scenario, looked at the U.S. share of that, and then saw that that's going to sort of result in hundreds of billions of dollars of lost revenue by the late century. But you actually see a lot of that come up in the mid-century as well. On the programmatic side, and this is what I think is perhaps the most new, we really looked at 5 different areas where we had good analysis, we had good data, and we were able to extrapolate the modeling that had been done into impacts for the U.S. fiscal picture. So I'll take them sort of line by line. The first is wildfire suppression costs. You can see the table, so I won't read it to you, but it's going to add $1 billion or $2 billion both by the sort of mid and late century. And it's something we've been seeing already in the domestic budget, where the 10-year average has been exceeded 7 out of the last 10 years. So it's no longer just a future issue. It's certainly something that's hitting us today. One note here, this is actually kind of a conservative number. What this doesn't do, and what frankly a lot of the wildfire modeling doesn't do, is account for the compounding impacts of things like drought. So for example, in California this year, we got into the tens of millions of dead trees. That's a result of a persistent drought that's gone on over a 5-year period. That exacerbates this picture. This is principally derived from a model that's focused on maximum average temperature and the number of days that we're hitting that. So this underestimates that, and it underestimates the impact, for example, of invasive species and how they might also increase the costs. The second, and this I think you'll probably hear from our discussants, is a thing that's front of mind for a lot of people. Climate change impacts variability in terms of yield and in terms of price. That in turn increases premiums for crop insurance. In the United States, we actually have a really robust crop insurance program. That's going to see dramatic increases on the late century time horizon, with the median being at $4 billion. But as you'll see in our report tomorrow, if you take out, we looked at 5 global climate models. If you take out the outlier, which is the low end, the number actually migrates to a much higher point estimate. So again, I think we're underestimating here again. The third area we looked at is air quality impacts related to healthcare. In the United States, we have a robust federal system that supports health insurance. It's fairly comprehensive, and one of the things that we see is, in addition to the mortality outcomes on the sort of late century time horizon, there's a significant impact on morbidity outcomes. That's air-related illnesses. That's the sort of traditional public health concerns that we have about people showing up to the hospital, heart attacks. Oftentimes, from a macroeconomic perspective, we calculate these impacts as lost days of work. Here, we're calculating that from a fiscal perspective as cost to things like Medicare and Medicaid. The third, and this is what's important to know here, is here we're only talking about hurricane damage. So we're not talking about extreme flooding, which we know costs us a bunch. Here alone, we're talking about the impacts of hurricane-related coastal relief. And this is a scenario that assumes both sort of weak climate action, but then also on the mitigation side, but also on the adaptation side. And so you see the result of that really hiking up the cost, $50 billion in the late century for the federal government. And so, you know, for those who articulate fiscal arguments against strengthening our infrastructure in the short term, which tends to be a couple $2 billion proposition, this is a pretty, I think, aggressive rebuttal to that argument. So that's the way we sort of walked through here. And then the last piece that I'll mention that I think we've done preliminarily, but we need to really get more sophisticated on, and I'm sure this is true for a lot of governments as well as for private industry, and that's the impact to your real property assets. For us, we're looking at $62 billion that are in the 100-year floodplain. That's a significant risk to the federal government of inundation by the late century. And so this really counsels towards both mitigation, but then also a really thoughtful approach to get serious about resilience and adaptation. for the United States. So this is just a quick snapshot on just the way we've approached some of the analytical pieces of this, focused on things like non-fatal heart attacks on the health cost side. We've talked about the different models that go into crop insurance, and the way we've sort of thought about it, really looking at geospatial data. Before I turn it over to Mike here, I think the one thing I want to note is going through this exercise, we've realized how nascent the economics literature in this space and how unattended to this line of inquiry has been. Both from a fiscal planning perspective, I think that's problematic, and I think probably from a private and other sovereigns perspective, that's problematic. So we're hoping that by doing this work, we're not just getting something going in the United States and not just leveraging the information that already exists, but really galvanizing, catalyzing additional effort into this line of inquiry.
Well, thank you, everyone, and it's a pleasure to be here at the US Center speaking. I'm Mike Wilkins. I'm the Head of Environmental and Climate Risk Research at S&P Global Ratings. I'm responsible for overseeing the ratings business impact of the research on the ratings and how we incorporate these risks into our methodology. We've been doing this for a number of years now, and one thing that we've been particularly focused on, especially my colleagues in the sovereign side, is how sovereign ratings could be impacted by climate change, and focused specifically on scenario analysis and on extreme weather events, or what is often known as acute weather change. And so, sorry, going the other way. One thing that we think could help bring some light to the argument in terms of the issues that Ali raised was how climate change impacted countries over a relatively long time frame. So a few months ago, our colleagues in Sovereigns worked with a major reinsurer, Swiss Re, looked at how, based on a sample of 38 different countries, how catastrophic severe weather events would actually impact the credit rating up to the period of 2050. Now, by catastrophic events, we're talking about 1 in 250 year events. And this was a sample size of around 400 natural catastrophes, which were simulated through the Swiss Re model. And what we did, in addition to looking at those events under normal, under normal conditions, we added an extra layer to the simulation, taking into account climate change, just to see what the extra negative impact of climate change would be. And essentially, what we saw was that in that scenario, climate change risks to sovereign ratings in advanced economies, in developed countries, was relatively negligible on average, but the ratings of many emerging countries and the emerging sovereigns, or developing, was actually fairly acute. Specifically in the Caribbean and in Southeast Asia. We looked at the way that could be mitigated, the natural, I suppose natural is probably the wrong word, but the way that it's usually mitigated through increased insurance to bring about some protection against these events. But we found that even with insurance coverage at 100%, it takes time to rebuild the infrastructure and other capital following a natural disaster. And during that time, government spending would be likely to be just as high in the absence of a natural disaster, and tax receipts would fall, so the fiscal position would be a lot worse, leading to even a greater deterioration in the credit position. Now, one thing I would just highlight about all this is that this is based on a 1 in 250 year type of event. What we could see is that made even worse with climate change bringing in the probabilistic type of analysis to 1 in 50 year being far more probable. So let me just show you what this means in terms of the actual, sorry, let me move this here. In terms of what's happening to various countries. You see the damage ratios, this is just for tropical cyclones as a percentage of economic value and properties in each country. So that ratio was what we focused on. So we looked at the simulation based on this, and as a starting point, we used property damage to value the results from natural disaster under climate change conditions. We assessed that by modifying the model's hazard component to reflect climate change and see what higher potential damages would be. The result was 1 in 250-year disasters becoming more damaging as climate change increases. And governments, in a sense, were hit by a triple whammy: the economic impact, the fiscal impact, as well as the overall monetary position and fiscal impact. Sorry, let me just coming on that. External. So that was the third element, the external impact, as the position of a country to its external debt would deteriorate. So that's the blue was the normal 1 in 250, and the red is the extra damage caused by climate change to those countries. You can see the countries most impacted, as I said, were mostly Caribbean and Southeast Asian countries. If we move on to the next slide, how that would impact the sovereign ratings over this period. Again, you see that it's the most developing countries which would be the hardest hit. Barbados, Bahamas, the Caribbean countries, Jamaica, and also countries, sorry, we lost the screen there, okay. The countries in Southeast Asia. But we also see here the extra amount of downgrade threat. So on average, the downgrade impact across all the sovereigns that we looked at as a result of a simulation was around 20% as a result of climate change. If we move on to which countries were most at risk, and you can see here, it really was a tale of the two halves, really. The advanced economies being relatively low hit, whereas the developing and emerging economies, as you can see here, in terms of additional change, as terms of percentage of value, additional GDP per capita loss, and additional sovereign rating downgrade, which is actually what we measure, it's really the developing countries which had the biggest impact. This follows on from research that we did actually the year before with taking into account what we call the vulnerability index. And this was based on a number of factors, including work done by Notre Dame Gain University, and looking at various factors which showed the exposure that countries had to climate change, such as percentage of coastland liable to flooding, the percentage of GDP coming from agriculture, and so on. And this heat map here, if you excuse the pun, really does show that it's emerging markets, developing countries, which are the most vulnerable. Again, Latin America, Southeast Asia, and the Caribbean being the worst. So as well as tropical storms and floods were the biggest ones that we looked at in the simulation with Swiss Re. Additional damages you can see here from tropical storms were far greater than floods, and especially if you're looking at the additional change in value and additional GDP per capita loss. So that was really one of the major results. And again, the difference between floods and storms in terms of rating impact was negligible. This simulation didn't include other climate change impacts, such as droughts, for example. That would make things even worse. And just highlight here how Thailand itself would face a relatively high amount of downgrade potential as a result of this. So Latin America and Asia, as you say here, would bear the brunt of this. So we've got here a split between Latin America, Asia Pacific, Africa, and Europe. And you can see really is Latin America and the Caribbean countries that really were most affected by this simulation. So just finally, just to wrap this up, one of the major objectives of this scenario analysis and this study was to try and see whether developing countries could try and protect themselves against this risk of a sovereign credit downgrade in the future in the event of a 100-250 probability extreme weather event, and that exacerbated by climate change. And as you can see here, the results would show that for a country like Thailand, it would have to take up to 74% extra insurance to try and mitigate that extra amount of lost exposure which would be brought about by climate change. And even then, that wouldn't bring it right down. It would just reduce the risk of a downgrade from 3.4 notches to 1.6. So that's not going to solve the problem altogether. And of course, that increase in insurance premiums would be totally unaffordable for a country like Thailand. So this is like in the world of the hypothetical. So on that note, I'm afraid, here is a picture of Thailand in a flood. It is a serious issue. It's a serious issue because once countries do face downgrades, their cost of debt goes up, and it turns into a vicious circle of economic problems. So this is just to highlight the problem. Obviously, there needs to be potential solutions, but one which is often touted, the insurance solution, can only solve it in a partial way. And I'll finish there. Thank you.
Great. Thank you for that, Mike. I don't have slides, so I'm just going to do this from where I sit. But that's an appropriate segue into the work that my organization pursues. CDP, formerly the Carbon Disclosure Project. We were founded initially to help track the carbon footprint of companies. We've since expanded to do work across a range of climate and energy indicators, water and deforestation. So we're now known as CDP. CDP was really founded on the idea of clarifying information, bringing transparency into the market in order to better clarify both the risk and the opportunity that might accrue to some of these natural capital issues. In the very beginning, there was a question about whether or not investors would value this information and whether companies would disclose this information. And if you fast forward 15 years, CDP was founded about 15 years ago, we now have over half of the world's market cap reporting through CDP. We have a third of all the world's investable capital asking for disclosure and transparency through CDP. So clearly, this is an area of material interest to investors who are providing the capital for corporate expansion, and it's an area of interest for companies who are also trying to manage these issues better and more comprehensively. So let me tell you what disclosure is, just to peel that onion back just a little bit. Disclosure is not a scenario. Disclosure is, not a modeling exercise. Disclosure is actually an annual snapshot of what a company is actually doing in their operations, in their procurement of energy, and in their supply chains on the issues of climate and energy. And from that, we can begin to get a snapshot of how companies are managing these issues and therefore integrating this into business decision making. And as what we've seen over the past number of years, there's kind of a cycle that companies pass through as they're grappling with this information. The first thing that happens is that the 800 plus investors who work through CDP will send a request to the companies they own asking them to disclose material risk and opportunity around climate change. And in the beginning, when the company starts to respond, at first it's got a bit of a compliance orientation. It's that, my investors asked me to do this, and therefore now I'm going to comply with that request. And it moves from there to comprehensiveness. Companies start to take the exercise seriously because then they find there's information there that's valuable to them that will help them better see risk that's not fully distinguished in the way that they source, procure, and operate. And it moves from there into management. Companies then begin to sort of find ways to integrate the data into the way that they make decisions around their operations and so forth. And then from there, it moves into strategy and to governance. And that's the place where you begin to see companies start to really make a difference in the way that they perform and in the way that they respond to these issues writ large as a risk and as an opportunity. And all of that begins to feed back as the signal of climate, of a changing climate begins to rise above the noise. And as we begin to see more and more extreme weather impacts, more and more business disruptions, and more things that companies must respond to, companies having this information at their fingertips are finding more and more ways to begin to use it productively. I should say there's a range of responses to this idea of risk as well. Some companies focusing on risk are purely concerned about regulatory risk. So am I going to be regulated in some way, and therefore I should be paying attention to this issue? And that's true, that's a risk that companies need to follow and so forth, and we certainly encourage companies to distinguish that for themselves. On the other end of the spectrum, though, there's a whole class of companies who are looking at the larger systemic risks posed by climate change and a changing climate to the economy as a whole. And those companies are the ones who are also starting to engage more productively on public issues. They're often the companies you see here at COP, and they're the companies that are trying to make a difference in terms of bringing their industry and other players together to advocate for comprehensive solutions, because climate change is a risk that is so large, it's beyond the capacity of any one company, any one investor, and any one country to deal with. So maybe just to bring it full circle to the work that Ali and that Mike were talking about, CDP also has cities disclosing through our platform. This year, I'm proud to say we broke 500 cities around the world disclosing through CDP. That represents somewhere between 6 and 7 million citizens around the world who are living in cities. And they're cities across a range of political environments. One notable tidbit to come out of the cities data this past year, that in the United States, cities across all parts of the country were reporting risks of climate change to their citizens involving public health, increased incidences of disease, water challenges, and all sorts of things. This was true not only in kind of major cities where you might expect that to be the case, it was also true in small and medium-sized cities across the country, and in parts of the country, frankly, where climate change is often questioned as a reality or as a serious issue that needs to be dealt with. And so out of the CDP data, what we start to see is that cities are a bellwether for these issues becoming real for people as the risk becomes translated into what their day-to-day life is going to look like. So you start to see when cities in these types of locations begin to self-identify climate change is coming online in a way that's going to be impactful, it's a sign that it's increasingly becoming aware and real to people who live on the ground. Certainly that's people who live in Bangladesh and live in other areas that have been hit by those extreme weather events, including New York City. That's no surprise. But the CDP data is increasingly being used to make those risks real, not only to investors who drive the process, but also to people in cities around the world as well. So I'll stop there. I know we're about to lose Mike in just a moment for another event, but we will, I think now we're going to take questions. Is that right?
Before we do, and before we lose Mike, I want to ask one question. As you go through this exercise, and some folks end up on the sort of the high end of the spectrum, how have you seen sovereigns respond to that, especially the ones that are the most vulnerable? Have you heard from them? How are some folks thinking about it proactively? Are there sort of good responses or bad responses to some of the work that you guys are doing?
I think the response that we're seeing is really built, if I use the word, excuse the pun again, built around resilience and around the additional infrastructure that's required to try and protect developing countries from the impacts of global warming. And this is being financed through a variety of different means. And one of the things that we're focused on at the moment at S&P Global is the world of green finance. And we're starting to see more and more adaptation green bonds being issued. So in the green bond market, most of it's been so far for mitigation purposes, for financing renewable energy projects, energy efficiency, transportation, and the like. But there's been a real surge of green bonds focused predominantly on adaptation measures, both from developing and developed countries, and the US included. US municipalities are more involved in adaptation bonds than any other country at the moment. So we've just actually launched our own approach to how to look at adaptation risk for projects. And we imagine that this is going to be used by many institutions, especially the multilateral development banks, in helping to fund countries adapt and also to allow much more transparency in how these countries can actually protect themselves through these financial instruments. And of course, the green bond market needs to be seen in the light of how investors will seek a return. So there's obviously a lot of focus now on putting in some form of guarantees, some credit enhancement into these instruments, and that's where developing countries can actually act in trying to help bring about these new instruments, because there is a huge demand from investors to put their money into green bonds, but it also takes the instruments to actually be put together, and a lot of it's not just looking at meeting your responsible mandates as an investor, but also making sure that your credit is protected. So that structuring is going to be very, very important.
Great, thank you. And let's give Mike a round of applause before he gets out of here. Great. Well, let's open it up and see if we've got questions from the group.
All right,
here.
we'll take some questions right here in the front. Please introduce yourself.
My name is Walter Merida. I'm the director of the Clean Energy Center at the University of British Columbia in Vancouver. My question is, what's the nature of the interaction, if any, from your organizations to the task force within the Financial Stability Board that was announced at the last COP?
Sure. I can start with that. First, we're incredibly supportive of that group's work. And in fact, at the G20, the leaders got together and endorsed that effort and said that we are looking forward to their results. We were part of that and pushing really hard for that. Second, I think we've started to do some of the work, and we've leveraged the work these gentlemen are doing in being an early adopter of some of those disclosure practices. For the U.S. government, we spend $440 billion each year on goods and services. That's a lot of money. And so one of the things we're doing is pushing our providers of goods and services, our contractors, to disclose that risk, do it in a way that's uniform, and leverage some of these best practices so that we are using our purchasing power to really drive that practice through the market.
And we at CDP are also very supportive of the work the task force is doing. We have been participating with a group of other investor and company organizations as a group, providing commentary, providing input that would help increase transparency, increase the usable information that's coming out, so that where possible, the burden is simplified for companies, because we know disclosure is complex. It's challenging for companies to get all the information out there. To where possible, simplify, and where possible, provide the information that would be useful for helping improve decision-making in the markets. So we and a whole group of other organizations, many of whom you'll see here, are participating pretty actively in that process. And maybe as well, just to build on Ali's last point, the federal government and the U.S. Navy are both members of the CDP supply chain program, and so are working with their suppliers through the CDP supply chain program to help disclose, identify what the carbon footprinting is for all of those major suppliers, and to try to identify ways to improve their performance and to reduce the carbon emissions associated with that procurement.
Yeah, I mean, I could try and give you a little bit of insight. I'm actually a member of the task force, so representing myself, but I suppose also S&P Global. So we're actually now at a stage where the final report, the phase 2 report, is going to be presented to the FSB. That's going to be next week. Actually, this week. I've lost track of time. This Thursday, the FSB will receive the final report, and then by mid-December, that report will be made public, assuming the FSB approves it, for public consultation. During the preceding 8 months, which has been, a very accelerated time frame, the task force has honed down the recommendations for financial disclosure into 4 key areas, those being governance, strategy, risk management, and metrics and targets. And I suppose I'll just focus on one area just to illustrate how our input has helped out, I believe, and that's in the area of strategy. Because a lot of the task force objectives has been really to try and ensure comparable and consistent disclosure by companies. So drawing together the many different disclosure regimes which already exist. I mean, somewhere over 400 different standards out there for disclosure in climate reporting. So it's been trying to condense that and make it consistent and decision useful, really, for the financial markets. And one of the areas that's been mostly focused on within the category of strategy and disclosing a company's strategy for dealing with climate risk is scenario analysis. So to go back to my presentation, the kind of work that the task force is asking companies to do is to look and produce and disclose results of scenario analysis related to climate, both on the risk side and also on the opportunities. And on the risk side, there is this recommendation that companies, where relevant and where material, should do a 2-degree reference scenario. So this is going to be fairly groundbreaking when it comes out. We obviously understand that for some companies, doing 2 degrees stress and scenario analysis is fairly new. So there's going to be a supplemental paper provided to guide companies, to provide reference points to show how scenario analysis can be beneficial. So it's not just a series of recommendations, it's also a roadmap and a guidance book.
Hi, I'm Mike Paperi, and maybe this is in part a follow-up to the last question. A lot of companies, a lot of governments are issuing long-term debt for everything from infrastructure projects to buildings to, you name it. Will this type of stress testing apply to, say, long-term bonds that are issued to finance some of these projects? I mean, I've noticed occasionally now there's a sentence or two in a bond document that says, by the way, you might want to think about climate risks associated with this road in a low-lying area or this building in a low-lying area, but it really doesn't go beyond that. Any thought to better disclosure within bond documents for long-term financing?
Yeah, I should stress actually that the task force stated aim is to have these disclosures in public filings. So you could include prospectuses as part of that. So it's really, what you say is really what the task force is aiming to achieve, but the level of disclosure will be broad, it'll be wide, it will be easily available for financial markets to make it comparable. And in terms of the impact of scenario analysis on long-term debt, I suppose that's an area close to my own heart because I'm actually an infrastructure analyst. I'm in the infrastructure group. And I know that when we do the rating on infrastructure projects, we look to the term of the debt. So most infrastructure projects are provided with 20, 25, or even 30-year debt. So it's very long term. So that kind of analysis needs to be undertaken not just for the next 3 to 5 years, but until the maturity of a rated debt instrument. So the task force and its disclosure recommendations for scenario analysis and that to be made public is actually going to make our job at S&P Global a lot easier.
And I'll just add to that, there are multiple sources of finance for public infrastructure. Some of it's the public markets, but a lot of it, frankly, is financed by federal governments. So one of the things we're doing is starting to put really tough standards on, especially in areas where we know the science, we know what the best practices are, put baseline standards against our infrastructure investment. Take, for example, our housing portfolio, where we've proposed baseline minimum flood risk management approaches. So if you're going to get funding to do infrastructure from the U.S. government, you got to build it a certain amount high because we know what the science tells us, what the modeling tells us, and we're not going to put good money after bad. So I think you'll see more and more of that from federal governments, where as partial financiers of public infrastructure, they're asking for people to think about this. So it's a little bit different than I think the bond markets, but it's a similar sort of pricing in of that risk. And I think it's going to get harder to do build what I think of as sort of inattentive infrastructure using public money.
And from the corporate point of view, the question is always, does doing this lower the cost of capital for companies? And there have been a few independent studies done over the past couple of years, Maastricht University, Oxford, Harvard Business School, that have looked at this question and show that there is, in fact, a correlation between companies getting a lower cost of capital who manage these issues as compared to companies who do not. CDP data has also been used quite a bit in the past couple of years to build low carbon indices. It's an input into the S&P low carbon index, the stocks indices that have just recently come out in Europe use CDP data, and the low carbon index that was released at Paris last year by the New York State Common Retirement Fund, starting at $2 billion, going to 4 or 5 after they have their first performance period evaluation, uses CDP data. It was designed by Goldman Sachs in partnership with us. And if you look at the low carbon index versus the non-low carbon index, the low carbon index, even if you backcast, outperforms the benchmark. So it's showing up both in returns and it's showing up both in lower cost of capital in an unambiguous way.
All right, do we have any other questions? All right here in the center. Loud, so maybe hold a little bit further away.
Hi, I'm Gwen Taraska from the Center for American Progress. I was just wondering if any of you have thoughts on how the G20 could perhaps carry forward the recommendations of the task force in the next summit.
Yeah. I'm glad you asked that because I had the same question asked me yesterday. I got a pre-prepared answer. But the G20 will be presented with the task force recommendations, I believe, in June of next year. And I use the word presented deliberately. The way that the process will work is that after the recommendations are approved by the FSB, assuming that happens, and it become public, it goes out to public consultation in mid-December. There's a 60-day process for that to happen, and then in February, the process closes, the consultation feedback is taken into account, and the report is finalized for presentation, again, approval from the FSB, and then it's presented to the G20, again, assuming that the FSB approves the final version post-consultation. Our understanding, and certainly my understanding, is the G20 then notes the contents of the FSB's task force recommendations. There's no sort of veto of the recommendations after that event. Okay?
And just for speaking for one of those countries, and not having seen the recommendations yet, I'll just add that I think from a U.S. perspective, we're really hoping that our regulatory bodies are stepping up and providing certainty and clarity to the market. Already, U.S. securities law requires disclosure of material risk. That includes environmental risk. So we hope that that's something that continues. We've seen the practice become more widely adopted, not just in a pro forma way, but in a way that's meaningful and sending, I think, useful information to investors. So I think we'll see that. And then there's the disclosure piece of it. I think there's this sort of broader question of fiscal health. Fiscal health impacted sort of indirectly through the market, but then directly to the budgets. This is a discussion I think each of the countries have got to do on their own, because while the contours are common, the drivers are common, there's going to be sort of bespoke responses depending on the unique exposure, the geographies, the assets, the industries that make up every country's economy and climate. And so I think there will be a lot of work for the United States to continue doing in the civil society and in the governments, and national and subnational.
Just one thing I really feel I should add, that the recommendations are voluntary. And you know, a lot of people say, well, that's going to be fairly toothless if they're voluntary. But I think you have to bear in mind the history behind all this. The FSB had a task force set up in 2012 called the Enhanced Disclosure Task Force, which was for banks. And again, those recommendations were voluntary, but they've been taken up by over 90% of banks already. So just wanted to stress that adoption of the recommendations are the key focus post-December, post the release of the market consultation. You know, the actual rate that companies adopt will be monitored very carefully. There's already talk about doing surveys and leaderboards. I imagine CDP may be involved in this as well at some stage, to actually name and shame companies which adopt or don't, as the case may be, the task force's recommendations. So the story doesn't end here. And on that note, I'll say goodbye.
And I don't want to go down the rabbit hole too far, but thank you. Dan Jurgen, who is has done remarkable work in the energy analysis arena, put out actually a report a couple of weeks ago that I think is really interesting. And he talked about the fact, or his perspective and his analysis, that transition risk in the oil and gas sector wasn't so high. I think one of the great advantages of the FSB process is that it's provoking that sort of discussion. And whether Dan's right or not, at least at this stage, is not the point. The point is that we finally got big segments of industry looking at their balance sheets, looking at their out-year investments, and stress testing them against an important risk that is posed to their lines of business. In our case, the line of business being the business of government.
And just to add to that too, I think disclosure of this nature was not very commonplace 10 or 15 years ago, but it's increasingly mainstream. It's expected by investors. Companies know how to do it now. This is not only in developed markets, it's spreading in emerging economies as well. One of the fastest growing areas in CDP disclosure is in China. The task force will serve to bring more information out into the marketplace so that the markets will figure out how to price this risk and how to build it into their valuations. And more information in that regard is useful and better. And I should just add as well that CDP, it will be aligning our questionnaire and our disclosure to the task force recommendations so that companies disclosing through CDP will be, quote, task force compliant with the state of the art in terms of what the FSB recommendations are.
All right, do we have any more questions from the audience? Well, I have one question, maybe directed at Ali, but Lance, maybe you too. There's a lot of work obviously went into the OMB data that you mentioned earlier. If there's people from other countries around here, what's some advice you would give if they're looking to do something similar?
Great. Well, first, I hope they are going to do something similar. And I think Mike's overview of the risks sovereigns face, the United States had a green color, and there were a bunch of folks who didn't. And so even with our green shading, we're looking at billions of dollars of costs and hundreds of billions of dollars of revenue loss in the mid and late century time horizon. So regardless of where you're situated on that map and what color you show up as on the S&P diagram, chances are there's value in investing time into this effort. The task is, I think, encumbered right now by the state of the economics literature that's out there and the modeling work that's out there. Part of the U.S. commitment, though, is to keep supporting this work and honing the craft so that we have more granular, from a geospatial perspective, modeling capability, and greater specificity of how some of the climate impacts crosswalk into macro and microeconomic outcomes. So we're going to continue to build that out. I think for countries that are starting to do this work, the work that the IPCC has done really is similar to the work that we do through our National Climate Assessment, which really serves as the backbone for this work. So chances are there are analogs through that process, through processes you have undertaken, whether it was in the build-up to your INDCs or it's your biennial reports or other things. I think there are a lot of analogs, and what is needed now is to take on the task of extrapolating what tend to be outputs that are non-fiscal or non-economic and crosswalking them. I think our process, which tomorrow's report, but more importantly the appendices attached to tomorrow's report will make very obvious, will provide a playbook that is easily replicated for a lot of folks around the world who want to try to take this work on themselves. And then now Lance can tell you how he can help you.
I think you know, if you accept that climate risk is systemic risk, and if you accept that the system that's at risk is the economy that provides all our goods, jobs, and services, and the very planet on which we live, then those, you know, green, not so at risk areas on the map, you know, don't have many places to hide. And this realization actually is what brought some of the big institutional investors off the sidelines, you know, starting 10, 15 years ago, to get into the game on engaging with their companies around climate risk as systemic risk, because they're long-term investors. They're holding assets. They're making investments far into the future and into perpetuity. And so when you have that kind of time frame, you begin to see shifts to the economy, shifts to the way in which the planet works, increasingly leave you with no place to hide, and therefore far fewer ways to hedge your risk. So it's actually quite economically rational if you're a long-term investor to begin to engage on risk from that point of view, and to begin to force more of a strategic way of interacting with these issues and managing for that. And so that's only going to continue, because the number of investors getting involved with this are increasing, and the number of companies who are seeing the value of doing it are also increasing as well. So the cycle really grows and continues from there.
All right, thank you. Do we have any last questions from the audience? If not, I'd like to thank both of our speakers, as well as Mike, who's now gone elsewhere, for, you have more comments? Or?
Can I just add one thing?
Yes, by all means, go ahead.
One of the big knocks against climate action for a while, from an economic perspective, has been that climate action impedes macroeconomic growth. Over the last couple of years, we've seen data that totally debunks that. Shows that the rate of growth for the economy and the rate of decline for emissions are just not connected to one another. That's one reason to not take climate action. The second reason people pose is that it costs too much to the government. I think this analysis is important for the United States and hopefully for a bunch of countries who also go out and do this, because it shows that the government can't afford to ignore climate action, because from a fiscal perspective, and if you're serious about the fiscal health of your country, you're going to take climate action as well. So I think, you know, we look at the sort of blue marble and we think, gee, why would you not take the insurance policy out to save it? And the first argument was macroeconomic. People knocked that down. The second argument is fiscal. We've knocked that down. And I think the work that Mike and Lance are doing shows that the private sector sees that writing on the wall as well.
Yeah, and if that's true at the macroeconomic level, it's also true at the economics of the firm level as well. And CDP data are starting to show that that companies are decoupling their income growth from their emissions growth. So that's happening not only at the level of the economy, it's happening at the company level as well. Now, to be sure, it's not evenly distributed across the board. There are some industries where that's harder than others. But there are companies around the world who are actively looking at this and making a successful stab at reducing their emissions while growing their business at the same time. And so that really is a good news story for all the things we're talking about, because then, it really does debunk the myth that you can't do one and have the other.
All right, let's thank our speakers here tonight. Thank you very much. We have one more side event here at the U.S. Center, and it's happening from 6 to 7